Hi everybody, Marco Carvalho here from businesscreditblogger.com. Today's video we're going to talk about how to get funding for your business. So at the end of this video presentation, you're going to learn whether you're a startup or existing business, what types of funding can you get? More importantly, what do you actually qualify for? So this is going to give you an indicator of what's available to you based on where you're at, whether it's your personal credit, your business income, whether you're a startup or existing business. So you're going to walk away with this presentation not only with information but solutions. We're going to provide to you some funding programs that we offer that'll provide you funding in 14 to 20 days for your startup or existing business. So let's get started. Now, what I'd like to talk about is why cash and credit is key. So as a business, as you know, whether you're a startup, you need the funds to launch your business. Your existing business, you need access to capital. There's different types of funding you can have access to for your business. There's cash in the bank, which is always good because obviously if you need to make payroll, you need a lump sum of cash, it's good to have that cash available. The other thing you want to have lump sums of cash in your business bank account for is because it's good for your banking relationship. What banks do is they look at your average daily balance, they look at your deposit history, they look at how long you've had your business account with them, and your NSF records, so you get a bank rating. So in the future, if you want to apply for a line of credit with your bank, or a business credit card, etc., the first thing they look at is your banking history. So having a good high balance in your business checking account is very favorable for you. So that's one reason it's good to have cash in the bank. The other thing is credit. Access to credit is crucial. So whether you need access to revolving lines of credit, bank lines of credit, there's different types of funding vehicles. What I always encourage business owners, whether you're a startup or existing business, is to leverage yourself. Make sure you have access to a diverse types of credit for your business. You don't want to have access to just one type of funding product. Like, let's just say all you want is a business credit card. That's great, but business credit cards serve certain purposes. But what if you need to make a major purchase and you don't want to worry about that high interest rate? That's where more a bank line of credit would serve you better. Or if you need a lump sum of cash, you're a real estate investor. Sometimes you don't want to deal with the balance transfer strategy with business credit cards and pulling cash out on personal credit cards, etc. So that's where a line of credit will benefit you as well. Let's say you need a lump sum of cash to make payroll. That's where it's good to have cash in the bank. So I want you to explore all the opportunities for you because it just gives you options as a business owner or a real estate investor. So let's talk about the benefits. Of course, you have access to working capital whenever you need it. You could start a new business or even purchase a business when you have access to capital. Acquire the equipment that you need. Now, the one thing I want to encourage you to do is don't ever wait until you need money to then go search for it. We have people who come to us all the time and say, well, I want to see how much funding I can actually get. I'm just curious. And then we do the pre-qual for them, and we can get them up to like 75 or 100,000 or even 150,000. They're like, well, I really don't need the money right now. Things are good. Well, that's the best time for you to get access to funding because when things are, let's say the economy turns or you need access to, you have an unforeseen expense, a major expense or a major piece of equipment breaks down, you have to purchase it. To have access to that funding already gives you that peace of mind. So it's important to dig your well before your business gets thirsty. Other benefits of having access to cash and credit, you can do a lot of things, whether you can fix and flip that next property if you're a real estate investor, you invest in the long-term future of your business. Of course, you'll see all these different items we have here. On the bottom of this presentation, you'll see it says businesscreditbuilders.org/pre-qualification. That's where you want to go if you want us to do a review for you to see what type of funding we can provide to you. We work with over 400 banks, credit unions, and lenders. So when our underwriters look at your credit report, we're not doing a hard pull. So that allows us to give you a realistic projection of how much funding you can acquire, what types of funding we can acquire for you in 14 to 20 days. So that's what that link is for. So let's talk about the types of funding for your business. Now, there's many different types of funding programs out there. This is kind of a rundown of kind of the major ones. Obviously, I'm not covering all types of funding here, but this is kind of the most common ones you hear about, and these are the most popular ones in the market right now in the industry. Now, if you're a startup, obviously you're a brand new business. On the eyes of banks, you're high risk as far as traditional banks go. So, because you have no revenues yet, you're a startup business, so you have limited options of the types of funding you can get. So, for startups, you'll see one of the easiest types of funding is installment cash loans. That's actually getting a loan, but there's a difference. Some people try to get a business loan to start their business, and those are much more difficult. Yes, there's SBA-backed loans, but for SBA, you have to have at least 20% of the funds in an account to show that you have that. So, for example, let's say you need $100,000 to launch your business, and you want a small business loan that's backed by the SBA, or let's call it SBA loan. Well, then you need to at least have $20,000 sitting in your bank account. That's number one. And that's not to mention all the other paperwork you have to go through. It is a timely process. You have to have favorable credit scores. But that's an option. But if you want a faster option, you want something that's much easier than going with a personal route. Personal installment cash loan is much easier to get to launch your business than an actual business loan, okay? Because banks are simply really restrictive to extending small business loans to a startup business. They like to see you have 2 years or more in business. That's their traditional route. So you want to get cash, you need a lump sum of cash, go the personal route. That's the easiest way to go. Bank lines of credit. Bank lines of credit are excellent. But if you're a startup business, again, you're going to run into the same roadblock. You're a startup, businesses or banks are simply not extending lines of credit to startups. They like to see your business tax returns, they see your net profits, they like to see history. So another optional is the personal bank lines of credit. And we do provide all these types of funding, by the way. So we could set you up with personal bank lines of credit. Now, many of you are thinking, well, as a startup, I want to have everything in my business names. Of course, you want to do that. And that's where business credit cards come into the play, which I'm going to talk about next. But having that line of credit in personal is good because it gives you access to lump sum of cash if you need it. And it'll give you access to do a lot more things if you just restrict yourself to just credit cards. Revolving lines of credit, that's the credit card option. That's where you can get set up with about 4 to 5 business credit cards. If you have good, strong personal credit, it's great to have our business credit card program because you can get 4 to 5 cards. The credit limits combined go up to anywhere from 100 to 150, but typically most people get anywhere from 50 to 80,000. You have to have exceptional credit to get the much higher credit limits, but that gives you access to working capital. And the best thing about it with the revolving lines is it's simple to acquire those for startup business. So you can get 4 to 5 business credit cards revolving in the company's name, your startup business. And this accomplishes 3 things for you as a startup. Number one, it protects your personal credit because the business credit cards through our program only report to the business credit reporting agencies. So this helps you protect your personal credit because all your debt on those cards won't show up in your personal. Number 2, this helps you build up your company's business credit because these particular banks report to the business credit agencies. So this will create instantly a credit file for your business. So you have 4 to 5 now bank issued business credit cards reporting on your startup's business credit report. So that's huge for you. Imagine that in literally 30 to 40 days, you'll have a business credit report for your startup with 4 to 5 business credit cards reporting with credit limits, let's say $10,000, $15,000, $20,000. Now that's excellent. Imagine if your startup now wants to apply for a vendor line of credit or a supplier line of credit, and that vendor now checks your company's credit and they see you have 40 or 50 or even 70,000 in bank issued credit. So that's the power of the business credit card program. And the third thing this does for you is this positions your business for credit limit increases in 6 to 12 months with those banks, provided that you use those accounts responsibly. And this also gives you access to working capital. So that's what's exciting about the revolving lines of credit for the business. The other types of funding you can get for startup is an asset loan. What is an asset loan? That's basically you pledging collateral to secure the loan or line of credit. The most popular type of funding that startups acquire for a startup is they use their home as collateral. So they get like a HELOC, a home equity line of credit. So they have equity in the property, they get a line of credit. from the bank and at low interest rates. It can be interest only for like 10 years. And those are great ways for you to get access to lump sum of cash if you have lots of equity in your home. That's a home equity line of credit. But remember, it's secured and you're putting your house at risk if you default. So that's where, when you go with unsecured, like installment cash loans, bank lines of credit, or revolving lines of credit, those are all unsecured. Now, the other option for startups is equipment financing. That's if you need a piece of equipment as a startup. You're going to have good personal credit, let's say 670, 680 higher credit scores. But those are much easier for you to qualify for because the equipment serves as the actual collateral. So you have decent credit, but also that particular type of financing, whether it's a lease or a loan for that equipment, is backed by the equipment itself. That's the collateral you're using, is what you're purchasing. Now, let's say you're an existing business. You've been in business for a couple of years. All the options that you see at the startups are also available to you. But now there's additional types of funding products that you can consider, provided that you have good revenues in your business. The first are an AR line. That's a loan that's actually secured by your accounts receivable. So that's an AR type of loan. Then you have merchant cash advances and the revenue-based lines of credit. Those are products that they use your credit card sales. I'm sure you're familiar with merchant cash advances. And then there's also bank deposits. That's another type of line of credit, which we'll get into in a minute, where it looks at your business's deposit history to judge what type of line of credit your business qualifies for. Then there's also invoice factoring. That's the purchase of accounts receivable for cash. And then there's purchase order loans. That's if you have like a purchase order from a major, let's say, manufacturer that wants to buy your product and you need to buy the materials and everything, but you have this purchase order and you need the funding. Then what happens is that's where your purchase order secures the actual loan so you can fulfill that product order. So these are just, it gives you a rundown of the different types of funding. And as you're a startup and your business grows, then you can also see that there's more other creative ways for you to get access to funding. What's important for you, though, as a startup or an existing business is to determine, number one, is how much capital or credit do you have access to right now, and how much do you actually need? Not just in the immediate, but you also have to look long term. And that's a thing that you don't want to think short term as far as all I need is this because I need to buy this piece of equipment. You got to think, is the equipment going to need servicing? Are you going to need additional funding in the future? What about, are you going to expand? Are you going to hire more employees? Or you have a marketing campaign you want to launch right now and you only need X amount. But what about your next marketing campaign, etc.? So it's good to set those projections, but most important is what is the return going to be on that money? That's putting the money to work. So once you have access to the capital, what's your return on your investment going to be? Important too, if you're a real estate investor, if you need, let's say, $100,000 in capital, and we can provide that to you, what are your projections to do with that capital? How many deals will that allow you to do? How much profit is this going to generate for you? So you want to do that. Project those numbers. How much increase in sales you're going to receive, etc. Now, the key is putting your cash and credit to work. That's the important thing. Is money is only beneficial to you when you put it to work. When you put it to work to help grow your business. When you put it to work to help you get some more real estate deals, etc. So there's two main factors, whether it's personal or business, that are going to determine the types of funding you're going to get is credit and income. Those are the two main things, okay? Of course, there's assets. That's another thing because that explores if you have assets, then personal credit really doesn't play a factor as much because the asset is backing the loan or line of credit. But income is very important because banks and want to know how you're going to pay us back if we provide you with a loan or the line of credit, etc. So first is, as far as personal credit goes, how's your personal credit? Are your credit scores in the 680 or higher range? How much personal income do you earn annually? Now, let me talk to you real quick about personal credit. The credit scores that you have, the 680 or higher, it's important to realize that the underwriters were going to look at some important things. I'm going to get into that in a minute on your personal credit. But as far as your income goes on the personal side, is your income verifiable? How much do you make? What type of income? Do you make W-2 income? Do you have pay stubs that you could support that? If you're self-employed, You have to furnish tax returns to show your income, because you could say you make $50,000 a year and you're self-employed, but the banks are going to want to see it on a tax return that shows that income. And if you can't prove that income, or let's say you haven't filed your tax return, then you have to look at only stated income funding programs, which I'll get into in a minute, which we don't have to prove income as far as tax returns. Now, are you a startup or existing business? What's your annual business revenue? What's the net profit of the business? The one thing that happens, and I want to share with you, is we have a lot of business owners that come to us who want a business line of credit, actual traditional business line of credit. And their business does lots of revenues. Let's say they do $100,000 or more in revenue, but at the end of the day, when we ask them, well, what's the net income? What's the tax return show as far as your net profit per year? And they say, well, we had a loss last year, and we only had a net profit of like $5,000 the year before that. So remember, if you have strong revenue, that's great. But the net income, as far as traditional business lines of credit go, is they look at the net income. They want to make sure after all your expenses are paid as a business, what's left over to be able to support a loan or line of credit. And that's on the business side. That's why many times business owners who have strong personal credit, the business pays them a personal salary, a good personal salary, but the business has net income of a loss. And then we do a review and they qualify for bank lines of credit on the personal side and cash installment loans, but the business doesn't qualify. And then they're upset because they only want business, but the business's tax return shows that the business has a loss. It doesn't have any extra money to pay for a loan or a line of credit. So that's what's important to realize, that your net income is what the banks look at. But there is an alternative. If you don't want to use net income, you just want to use your bank revenues or your business revenues, is there's a bank line, your checking account. You can lose your business revenue, but that's a higher risk type of line of credit. I'm going to get into that in a minute. Okay, so I want to try to stay focused here because there's so much to explain to you. Now, what are the underwriters look at when it comes to your personal credit report? So this is really important for you if you're going to apply for, let's say, business credit card funding program or one of our maximum funding programs. They look at scores. Scores are just a benchmark indicator. That's not the only thing they look at. So if you have a 680 or higher FICO score on all three bureaus, check mark. That's great. Okay. You could be sitting at 670, but remember, this is the bare minimum. It doesn't mean that you're going to qualify for tons of money. There's other factors. There's, of course, your payment history. Do you have any late pays in the past 12 months? Primary accounts. This is huge. Many people have authorized user accounts to help boost up their score, but they're not the primary account holder. So you want to be really careful. You want to make sure that if you add an authorized user, that your authorized user account is not the strongest credit account that you have on your personal credit report. Because underwriters catch that all the time. They want to look at your primary account holders. Also, they want to look at the size of your credit limits on your revolving credit cards. Do you have a $1,000 credit card, or do you have a $10,000 credit card in your personal name? Those are all going to impact how much funding you're going to qualify for. Because remember, when they look at that, they say, okay, the individual owner or the individual themselves, the banks, your credit worthiness is dictated by the size of the credit limits that you currently have, the amount of credit exposure, your history, how you manage the money that you currently have available to you. So if you have only $500 or $1,000 credit card limits, then you're not going to be able to get business funding a large amount, if any. You want to at least have a $5,000 credit card in your name primary, and that it's aged, not 6 months old, not a year. A year old would be okay. But one thing that people do is they make a mistake is they try to open a couple of cards and then they come to us trying to get a lot of funding when they just opened a couple cards 3 or 4 months ago. That doesn't work. Okay, so the size of your credit limits, credit utilization is another thing that's important. And now, credit utilization is just on your credit cards, not on your installment loans or anything like that. So ideally, you want to be at 50% utilization on the individual accounts and overall accounts. If you're at 60 or 70%, that's fine. Don't worry about it. But if you're maxed out, then, and we do a review, just realize that you may be required to make some pay downs to qualify for funding. which is great though. Don't pay down anything yet. Let us do the review. That way the underwriter can give you the instructions on which particular accounts you need to pay down, if any, okay? Inquiries are a big thing. What I don't want you to do, and it happens all the time, is many business owners or even investors try to shop around and try to see what they can get on their own. So they make a couple inquiries, they try to apply here, apply there, they get denied, or they didn't get enough credit. Then they come to us and say, I want to get $100,000 in funding or $150,000 in funding, but they have 6 inquiries in the past 30 days. It doesn't work that way, okay? So if you're looking seriously to get maximum funding results, don't go out there and apply for credit prior to pre-qualifying for funding. The other thing is if you recently got a mortgage or auto loan, that's okay. That doesn't really impact you as much because the underwriters understand that those are different types of funding products. Okay, so we understand if you got a car 30 days ago and they pulled 4 inquiries, the dealerships did, that's not a concern, okay? Now, what do underwriters look at when it comes to your income on the personal side and the business side? If you're strictly using your personal income, you can verify personal income. They look at W-2s, they look at your tax returns. They may require you to furnish that. So when you can verify personal income, that just opens so many more opportunities up for you, okay? Let's say you only have rental income. You have a couple of investment properties and that's the only income you can prove, but it's substantial. Then you can use bank statements for rental income. And it could be personal bank statements or business bank statement. That's fine. On the business side, they want to look at your business's annual revenues. And like I said, they pay attention to the net income of the business. Now, let's say you don't want to prove income personally. You just have good business income. You want to use just business only. Then what we're going to look at is the net income on the business, the annual net income, which I told you about. So if you're making $30,000, $40,000 in net income at the end of the year on your tax returns for the business, that's good. That means that the business has profitability and it can support a line of credit. For us to do a review strictly for business, you have to provide those 2 years business tax returns. That's going the traditional route. Let's say you don't want to provide business tax returns. Your business, let's say, does $10,000 or more a month in revenue, and you have $10,000 coming into the business check account every single month, or even $5,000. You're doing, let's say, $60,000, $70,000 a year in gross annual revenue, but you don't want to provide tax returns. Great. There's a funding product that's strictly based off of the business bank deposits. You can look at the link here. It says banklinecredit.com. That will take you to our blog post that explains this particular lender, that you basically sync up your business's checking account and they do a review on the deposit history. There's no personal credit check. There's no personal guarantee with this particular product. And they extend your business a line of credit based on its bank deposit activity. And you literally can have an answer within a matter of hours, and you can access your line of credit online, choose how much you want to draw on your line, and they deposit the funds in the next day, 24-hour deposit. And again, it's a great product if you have strong business revenues, and let's say you even have bad personal credit. You don't want to use your personal credit. That's a great product. Now remember, with that particular product though, it's not the cheapest because your repayment terms are 6 months, so you can't draw it out as long when you draw on your line of credit like a traditional line of credit, etc. But it's a great option for business owners that want access to funding right away, don't want to use their personal credit, don't want to provide a personal guarantee, and let's say they have bad personal credit, but they have $10,000 or more in business revenues coming in. That's an option. So check out banklinecredit.com. The other thing is merchant processing statements. That's another type of funding where basically, and you'll see there's a long link on here. This is the actual blog post where we explain this more in depth and give you another lender option if you have good credit card sales going through in your business every month and you don't want to use your personal credit, you don't want to, you strictly want to use the business, okay? But then this is more for existing businesses that have revenues, okay? What if you can't prove income and you can't prove a personal income, you can't prove business income, or let's say you don't want to provide either one of those. You don't want to provide those documents. Then you have to go to what's called stated income. And that just narrows it down to you to one option. That's personal and business credit card funding. If you want to go stated, that's what your option is. You got to go credit card only. Okay, so our business credit card funding program is ideal for those of you who can't prove income or don't want to prove income, and it gives you access to funding. So our strategy is to get goes in 3 stages. So our business credit card funding program. Let me go back real quick. You want to go, if you strictly want the business credit card program, go to businesscreditbuilders.org/pre-qualification. You'll have to provide us a tri-merge credit report to do a review. In about 24 to 48 hours, we'll let you know how much in business credit card funding you qualify for. But keep in mind, make sure you select the business credit card where it asks you what funding program are you interested in. But the one thing I want to let you know, if your personal credit is not strong enough, okay, for business credit cards, you may qualify for personal credit card funding or some of our other options, but that's if you can prove income. Okay, so the one thing I want to make sure you understand is when, as business owners or investors come to us and they want a specific type of funding, all I want are business credit cards, and then we review them, and you don't qualify for business credit cards, but let's say you qualify for a cash loan or a bank line of credit because you have good income. What I encourage you to do is, the most important thing is if you know what you're going to do with the money and you're going to put it to work to grow your business or grow your assets in real estate, let's just say, then take advantage of that opportunity and put that money to work. Okay, so what I always use the analogy is, it's one thing to know what you want, but it's what you actually qualify for is the pill you're going to have to swallow. Like we all might want, let's say, a Mercedes or a Lamborghini, but we go into the dealership and our income and our credit shows we can only get, let's say, a Taurus or something like that. Not to knock Taurus owners or anything like that, but I just want you to understand it's all relative to your credit, your income, and where you stand. Okay, so we're going to do our best when we pre-qualify you. We want to let you know exactly what you qualify for, because we don't want you going out there applying and getting declined. Our goal with our program is you're leveraging our network, you're leveraging our expertise to get you the exact type of funding, the highest credit limits possible, the best rates, so you could grow your business. So let me explain to you our maximum funding program. Now, this is for those of you, whether you're a startup or existing business, let's say you want to get as much funding as possible, you want to raise as much capital as possible, and you want it to be completely unsecured, no collateral. So our strategy basically is to get you maximum funding in 3 stages. So at the end of the funding process, you have access to lump sums of cash in your account, you have access to lines of credit, okay, so you can grow your business. So stage 1, what we do is you're providing us your tri-merge credit report. You're going to go to that pre-qualification link that you see at the bottom there. You're going to let us know what your income is. Are you W-2? How old is your business? What type of business do you have? This allows, and you're going to furnish us your tri-merge credit report. So to do a review, we're not doing a hard pull. We're just reviewing your credit. Once qualified, we'll give you projections, and then we take you through funding process. That's once you complete our funding agreement. So what happens is, stage 1, we provide 1 to 3 cash loans for you with $25,000 to up to $300,000 in combined cash. And the beauty of that is your interest rates are 6 to 15%, but your repayment terms can be 2 to 7 years. So you can accept or reject the loan offers that are presented to you by our banks. That's the beauty of it. You're not forced to take a loan. So if you get 3 offers and 1 offer looks great, accept that loan offer. You get the cash in the bank. And then once you're done with the loan offers, we moved on to stage number 2. And that's where we actually set you up with 1 to 3 bank lines of credit. This is actual lines of credit at the bank. You have lines up to $50,000. Typically, banks go from 20 to 30,000 lines because you're a brand new customer. You don't have a relationship with them yet, so typically it's up to 30,000, but max is 50. Interest rates range from 7 to 12%. You could draw on your lines using convenience checks. This is really great with real estate investors because you don't have to do the cash advance balance transfer game with credit cards. You just, if you have a $30,000 line of credit and you need $20,000 down for a property, you just stroke a check, money's in your account. Okay. Now, stage 3, this is optional at this point. So let's say you got all the funding you need through stage 1 and 2 and you're done. We can stop there for you. That's fine. But if you want to keep going further, we go through stage 3, which is getting you lines of credit. That's where credit cards, business credit cards, 3 to 5 of them. You'll see combined credit limits 15 to 150K. They come with 0% introductory rates for 6 to 15 months, depending on the bank. And your rates will range from 10% to 19.9%. One thing that I want you to encourage you is to check out our video on the balance transfer strategy, because most people get concerned is, what's my annual interest rate going to be on my credit card? I want you to understand that you don't have to ever worry about annual interest rates, because you can always reset your 0% intro APRs. And how do you do that? It's simply making a phone call to the card issuer. If you have one card where you have, let's say, a $5,000 balance and another credit card that has zero balance, and let's say your intro APR on that zero balance card expired, you call that card company and say, hey, I'm interested in transferring a credit card balance. What type of balance transfer offer can you offer me? And I'm telling you, they're going to offer you 0%, and most likely it'll be 12 to 15 months, because they want your debt. That's the key. They're hoping, credit card companies are hoping that after that 0% period is over, you didn't pay it off, and now you have debt, and now you're paying the interest rate. Okay, so that's how the game works. So you can leverage that to use the balance transfer strategy. Now keep in mind, when you do balance transfer though, card issuers will charge 1 to 3% balance transfer fee. But that's a minimal fee if your plan is to pay that off before that 0% APR period expires. Okay, so now on the business credit cards, they only report to the business credit reporting agencies, like I explained to you earlier. So if you want to pre-qualify for, let's say, business credit card funding, or you want to go through maximum funding and get as much funding as possible, the step 1 is you have to order your tri-merge credit report. What is a tri-merge credit report? That has basically Equifax, TransUnion, Experian all blended into one report that has all 3 of your scores on it. So we suggest going to businessfundingengine.procredit.com. Now, what I do suggest is don't furnish us one credit report that you got on your own from another service. A single credit report will not allow us to do a full review, because all 3 credit reports are different. All 3 scores are different. So the reason why you don't want to do that, let's suppose you have one report that has strong score and you furnish that, and then we gauge your funding projection on that, and then you say, that sounds great, let's move forward. Then we move forward with funding, but your TransUnion, Experian, let's say, the 2 reports you didn't furnish us, let's say there were some late pays on there, or let's say the scores are much lower. So you're only doing a disservice to yourself if you don't provide us the full 3 reports, okay? So make sure it's a tri-merge report. Number 2, download a report in PDF format through the ProCredit dashboard once you get it there. And then you're going to upload it through our secure site. So you're going to go to businesscreditbuilders.org/pre-qualification. So fill out the form on the pre-qual, upload your credit report. You're going to get an email confirmation from us to let you know your report's received. It's in underwriting, along with some instructions. Basically, the email tells you don't apply for credit, don't shop around, because that's going to only hurt you with the projection. Okay, and then 24 to 48 hours, we'll give you a call back via the phone and go over the funding projections we have for you, what funding vehicles, types of funding you qualify for, and what the cost is, next steps for moving forward. Then we send you out the agreement, fill it out, you can scan it, email it back, and then we assign you a processor, and the funding process starts. That takes 14 to 20 days for you to receive the funding. So with that, if you like this video, give it a thumbs up. So click the subscribe button, because we're putting out videos like this on a regular basis, and check us out. businesscreditblogger.com. That's our blog where we're constantly providing funding strategies, how to build your business credit. Whether you're a startup, existing business, or real estate investor, taking the time to understand funding and how to maximize and leverage your company's funding and your personal credit is going to allow you to get access to the cash and credit and capital you need to grow your business, expand, and scale your business to the next level. So with that, I really appreciate you for listening to this presentation. We'll talk to you real soon. Make it a great day.